Are you not sure which fair value gap to use as an entry? Do you mark them everywhere and take sometimes the incorrect entry? In this video, you'll learn exactly what a 15-minute fair value gap is and which ones are not. After this, you'll be able to spot valid fair value gaps in a second and ignore the fake ones. I'll also show you how to use the Fibonacci tool and how to implement them on the charts. Now, what is a fair value gap? You ask yourself. A fair value gap is an imbalance that forms after an impulsive move. It is a pattern of 3 candles, and those 3 candles, as candle 1 and candle 3, are wicks in between and they are not touching each other. That second candle is the fair value gap. So what you see here is my drawing. We have a 3 candle pattern and it's in a down movement. We have an upper wick on the first body of the candle, we have a body of the candle, and we have a lower wick. Same in the second one, we have an upper wick, a body, and an under wick, and a lower wick. Third candle, we have an upper wick, a body, and a lower wick. Now, the fair value gap itself, I already marked it out. It's actually, you can see, I've drawn them in blue especially so that you can actually see what happens. So in here, you can see exactly, we have a blue wick down and a blue wick up. These 2 wicks do not touch each other. So I've drawn a line over them so that you can see it clearly. And the space in between those 2 wicks is a fair value gap or an imbalance. This is how you spot fair value gap. This is the definition actually of fair value gap. If you don't understand it, just rewatch it. It will get clearer in a minute. Remember this, fair value gap is a zone where there is left open orders that did not get filled because of the strength of the markets moving in one direction. So what happened here, I'll show you exactly. So because the market was moving down, the market opened a new candle and the force of selling power actually was so strong that the wicks were unable to touch each other because the market did not came back up. By buying pressure, it immediately starts flushing further down. And most of the times, the third candle will be a bit bigger also to the downside. But how big they are doesn't matter. This is the imbalance itself. So what is left in this opening is left open orders. That means that the market is drawn back to there and people were shorting in this part too, but the order did not get filled in the order book because the market was moving so fast down, they left open orders. That's why actually the market comes back to get them. If you're new to trading, I would recommend only using the 15-minute time frame as fair value gaps do. Why? They have less noise. You will be more confident in taking trades, so you will not take trades that are not unnecessary, and you have a repeatable process. It's very important that you can repeat the process over and over again so that you actually know what you're doing. What I see happen so many times, because people don't see the difference between a fair value gap that can be used and a fair value gap that cannot be used. So I'll explain. Fair value gaps are not a zone you can draw everywhere. So not every fair value gap holds any value. I'll explain later too. An entry without a break of structure or a change of character. So that means that you need one of those two, and then we need to create a fair value gap out of it. That's how we know it's a good fair value gap. A fair value gap in a chopped range. That is noise. That means if the market is just going sideways, and normally a chopped range would not even have a fair value gap. A ranging market does have fair value gaps, and it's not easy to trade, so do not trade it until you see an impulsive move. A small gap that is not an impulse. That means if we have like a mini gap in between two those are not impulsive moves. Something that forces you to take a trade. What I mean by this is, if you are not sure and you cannot spot the fair value gap like in a few seconds, that means that you're actually your brain is tricking yourself into wanting to take a trade. And that's not what we want here. We want to be able to take the right trades, the right possibilities, so that you actually grow your account. So not every fair value gap is tradable. Most of them are just to confuse you and make sure that you are not trading the right ones. After this movie, you'll be able to spot them immediately. I'll even help you with this. I got a tool that's called the Fibonacci that will help starters figure out which ones are easier to use. I'll take my tool for a second, I'll open it and just copy those settings and you'll be fine. The Fib tool itself is right here. It calls Fib retracement. This is exactly what you need to put in. And these are the settings I use. If you are putting in these settings, I give you a nice pointer to go to templates, click on it and press save as. If you save it, you will be able to get this one in here and then you can type a name, say FVG Fib tool. So FVG Fib, you save it. So if you ever need different settings, like I have retracements, my settings then change and I make a different setting. And this way you can always easily go back to it. I would recommend that we go to the charts. Let's add to everything that we learned already. You learned already in the previous episodes what the break of structure is and a change in character. If you haven't, go watch it before you continue here, because if you haven't seen that one, you are unable to implement this info. So we have a naked chart right here, and I'm going to show you exactly what I mean and which are fair value gaps. You will see a lot of them, but only a few of them we're going to use. So where do we see fair value gaps? We see one here. We can spot one here. You can spot one here. You can spot one down here. So you can see them immediately, and it's exactly the same like I shown before. I'll delete this one. We have a wick, we have a body, and we have a wick. These two wicks do not touch each other. The place in between is the imbalance or a fair value gap. Like I've shown before, we need an impulsive move. So what's an impulsive move? This is an impulsive move. It's a huge candle moving in a direction. Same here. We have a huge candle moving in a certain direction. That's an impulsive move. So to make it easy, what do? We had a low. After, we've taken out this low with force, and you can see with the second candle we've taken it out with a huge amount, with a few points. That's a nice new break of structure that we've just made to the downside. After we have done this break of structure, we are going to take a look if we have a 15-minute fair value gap. What do we see? We have a 15-minute fair value gap right here. Great. Now, how do we know if this is a good fair value gap, yes or no? Now, the easy way is we have a break of structure, so that says we have a good fair value gap. We need a break of structure, and then it needs to create a fair value gap above the 50 level. We use our Fib tool. I've just pressed it. We take the wicks high and we take the wicks low. And we draw it from the upper part to the lower part if it's downwards. If it's upwards, you draw it from down to up. If you aren't correct, you will see that the numbers are different. So just draw it differently. You'll get used to it. Now, where is it a valid spot to take an entry of a trade? This full body was actually a valid trading space. The only thing is we need at least a certain amount of R collection before we take a trade. So we should have been shorting. I would take it from here somewhere. It stops at the high. And we need a 2.5. So we can see this is not a 2.5 yet. If we draw it up, here we had a 2.5. So make it a 2.5. If it doesn't come to that entry, that's not a valid trade. So I would have said a little bit above, this is a 2.4. You should have had patience. You saw the market moved. And the market moved lower again. Because if the market continues in the trend what we are trading in, you will have to have patience, because this took from that imbalance until we got actually triggered in our trades, that took 7 hours. So this takes a bit of patience before you can do anything. And then the market started moving in our direction that we actually wanted to see it move. Where does it head to then? The market heads to a new low. So it should take out this low right here, because then we form a new break of structure to the downside. This is a valid fair value gap that we can spot. I'll show you another one. Right here, after this impulsive move came, we made a new BOS to the downside. This is an impulsive move. We see a clear, huge move down. So if we see this kind of movement, we take again our fib tool. We draw it from the wicks high. So where the market stops. And where the market should stop is actually when the market starts moving back upwards. So the first candle that moves back upwards right here. The previous one, the last one that goes down, that's your end of your fib tool that you have to put it. Not on this one, on the one that is still in the downtrend movement. Even if the wick goes lower of the higher one that goes back up, it doesn't count. That one is a bullish candle. We only take when the trend is moving the same direction. Now, what did I say before? We need a 2.5 R. So the market should be heading back to this low. If we are correct, what do? We take our short tool and we start looking. This is a 15-minute fair value gap. We put it at the high and we draw to the lows. What do we get? We get a 2R. So we want to see if we can get a 2.5. 2.4, that's a 2.5. So just a bit above is a 2.5. We are happy with that 2.5. Great. We let the market do its thing. We did not enter anything in between because this is that break of structure that we made. We have patience, and from that low back to the high, it took again 5 hours, 7 hours almost, and then we started moving again in our direction. Until you got actually profit, that took 9 hours. So you had 9 hours to put in that trade. That's plenty of time. So these are two valid spots. Now, again, we have a break of structure right here. You can see the market is slowing down. Now, where should the market come back to? We do it again. We draw it. The market will come back up. So we have a 15-minute fair value gap. That's the high. And we should come back to the lows if we continue that direction. So we could take our short tool again, put it at the high. Let's see if we can get a 2.5 out of this. This is only a 1.6, so we need to draw it higher. The only thing is, you can see we do not have a 15-minute fair value gap anymore. So this would not be a valid trade. Here we cannot take that trade. So we should be patient again until we do have another structure that does show it. Now I'm going to show you a fair value gap that you should not be trading. So right here, you should not be trading this fair value gap. This one also had a fair value gap inside. Why should we not trade it? It's below fair value of price, so it's not a valid fair value gap. We need those 2.5 Rs to be able to get profitable over the long period of time. So this is a valid fair value gap. Now, can you enter on this fair value gap? You probably ask me. Yes, you may. Because we should still go to this break of structure downwards. Where should you put your stop? Still at that high. You must still put your stop at how you draw your fib to. You will not, I repeat, you probably will not get your 2.5 R then. But this is still TP1, and probably, if you're lucky, you should have drawn a little bit further down, but this would have been a 1.3 R, 1.2 R, but it's still a valid trade. Make sure that you at least get a 1.5, otherwise I would not take it. Do not move your stop, you have to move your entry up, so that you have a smaller stop, not the other way around. So again, in explanations, I just shown you what a fair value gap is. I shown you on a 15-minute base how we can use them, very easy to spot and very easy to use. Only use them after a break of structure or a change in character. If that doesn't happen and any other thing happens, it's a no trading. In the next episode, I'll explain what premium and discount is and a 50% rule that fixes your not good entries. Let's go watch the next one.